In this video, I want to talk about the best portfolio structure for long-term investors in 2026. 2026 is coming soon, so how to benefit from the current economic environment, how to optimize your stock portfolio so you only pick winning stocks, you only pick quality stocks to generate a large outperformance compared to the market. How can you beat the market? This is what we are going to talk about. And I have a list of themes for 2026 to monitor because a lot of things are happening at the same time. So let me start with the first ones. If you look at the top-down approach, obviously you want to look at macro and the global economic environment. What we have right now is inflation still high, inflation still sticky, roughly 3%. It will be very difficult to go from 3% inflation to 2%. Very difficult. And also, at the same time, you have some changes in the Fed interest rates. At the same time, you have an economic sentiment that is bad. Let me show you this tweet from Jesse here and the Kobeissi letter. The US consumer sentiment assessment of current economic conditions have declined to 50 points, the lowest level on record. I like to look at this data. I think it's really helpful, and I think that's a great way of measuring bullishness in this market, how people feel in this economy. If you look at great letters from great investors like François Rochon, for example, this is a big legendary investor that has outperformed the market for 30 years. And he's talking about this as a great gauge to see if we are near a bottom or near a top. Are people feeling too optimistic or too negative, too pessimistic? And now we are the lowest level for the past 50 years. This comes as America's perception of current buying conditions for high-ticket items deteriorated to the lowest level on record, an ongoing affordability crisis and a weakening labor market continue to weigh on household finances, dragging consumer sentiment lower. Consumers have rarely been this pessimistic about the economy. Yes, the sentiment is quite bad, and we are reaching a point below COVID, below 2020. Yes, this is subjective, but historically speaking, this metric works. Strangely enough, when this metric is down below 60, it's a good time to buy stocks. Strangely enough, when it's down below 60, countries panic. And I have a point to make here, because now that you have a new administration in the US, pro-business, pro-stock market, you have an untapped potential with more stimulus, which means this metric can rebound quite easily. You give checks to everybody, exactly like we had in 2021, and for 2021 it worked beautifully because of checks and all stimulus reserves. This ratio went back to 80. So I want to start this video by saying this. You have a little bit of a pessimistic sentiment in this market. And at the same time, I want to cross-read this with a tweet from Jesse. There is only one path for Trump to win midterms. In the US, you have midterms in 2026. You pour gasoline on the economy and pump it as hot as he possibly can. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. So you may have a lot of announcements in 2026, and I'm not saying anything politically, if this is bullish or bearish. I'm saying I will monitor what is happening here. Because if you have stimulus checks, for example, it will help certain kind of companies, Home Depot or Lowe's or furniture companies. If people are given checks of $2,000, for example, they will buy things, more consumption. If they are given stimulus checks, they will buy more clothes. They will go more to the restaurants. So retail stocks will be helped if the US government intervenes and gives money to people like this for free. Also, it will lead to more inflation. This was my first point, interest rate inflation. Now inflation is going down a little bit. You have some cheating, but it's still trending down. The trend is still here, flat or slightly down. What if you give stimulus checks to people? What if it creates more inflation? If it creates more inflation, the Fed will never cut interest rates. So it will be a tricky situation, and this is a key theme to monitor in 2026. Now, what can you do with your portfolio? Now that you know this, now that you know that you have 1, 2, 3 metrics happening at the same time and moving in the same direction at the same time. Well, you can only invest in companies that will benefit from inflation in case inflation picks up. Meaning, you want to avoid companies that will suffer in case inflation starts again. Okay? So companies with a lot of costs. Companies that rely on, specific prices that are fixed. Or specific prices that move too much. On the contrary, you want to optimize your portfolio for 2026 to only invest in companies with pricing power. Asset light, very nice margins. They can increase their prices every year to offset inflation with minimal cost, fixed cost at a very low base. This is how you want to optimize your portfolio for 2026. Next point, diversification done wrong kills performance. You probably know that the S&P 500 is concentrated. You probably know that a lot of people love diversification. You probably know that people want to move away from the Magnificent Seven companies. They are worried about this concentration risk. I would say the same thing is true for portfolios. Some people worry too much about diversification. I see too many portfolios being too diversified. 30 stocks, 50 stocks, 80 stocks. The majority of people, when they have 80 stocks, they don't know what they own. They don't know the kind of stocks they have. And I know this quite well because I have a coaching program and I have calls on a daily basis of people who want to join a coaching program. And the profiles are very much different. You have people that are aggressive, more defensive, etc. And a lot of people have a diversified portfolio. And I ask them this question every time. Do you know what you own? Can you list 3 things that are positive about every one of your stocks and 3 things that are negative about all of your stocks? And they can't. That's funny, right? So you dilute your attention by looking at too many companies at the same time, too many metrics at the same time, because you don't know what is important and what is not important. It's better to focus on a few ideas, a concentrated portfolio, to only focus on the best companies you have in your watch list and to know what is important. You don't have an infinite amount of time. Your time is precious. Your time is limited. So why would you want to dilute your attention? You are not a fund manager. You are managing your own portfolio. You can do whatever you want. So why should you own 100 companies? Because of ignorance? You're literally telling the world that you don't know what you're doing. If you don't know what you're doing, you can buy an index. You can buy an index and be fine with it. So you can go sleep and play with your kids. Why do people own so many stocks? Some people own 300 stocks. I find this completely crazy to invest like this. And they expect to have 300 stocks and still make 25% per year, which is a little bit delusional. Very few people have done it. You have Peter Lynch that has done it in the past, and he had like thousands of stocks, but he was a professional money manager. He had a lot of time and a team dedicated to turning rocks. You don't have a team. You are watching my video on YouTube for free. You are a retail investor. So you are not a professional. You are not Peter Lynch. People look at this example of, but Peter Lynch made a killing in the stock market and he was diversified. You are not a professional money manager. It's not the same game at all. Not the same game at all. So concentration. As a retail investor, this is how you can optimize your portfolio. Next point. For me, by the way, if you want to check my portfolio is public. You can type my name on the internet on eToro. You also have a link in my description to access my eToro portfolio in real time, every day. I have 12 stocks. The big convictions have a 15% exposure. The core positions, they have roughly 10%. MasterCard, MSCI, Meta Platforms, Fortinet. And the rest are medium conviction, a little bit of trimming here. 12 positions. I know everything about my positions. I know everything about my stocks. I know what can go right. I know what can go wrong. I know the kind of metrics you need to monitor. I know the kind of metrics when it's a waste of time to monitor them. I know what is important, what is not important. Do this exercise for your portfolio. Do you know the 5 most important metrics for each of your holdings? Do you know what are the 5 most important things? If you don't know, you can always work with me inside my coaching program, but you have some work to do. Okay? Each stock in your portfolio must earn its place. If you want to build a strong portfolio, how do you allocate? Either you buy like 3% of your portfolio, or 5% of your portfolio, or 10, or 15, or 20, or 25. How do you allocate your portfolio? It's all about this risk-reward ratio. Normally, your biggest company, your biggest stock in your portfolio, the biggest allocation, should be your safest one. The one that will not double in value, but with the lowest amount of risk, because it will give you stability. It's the foundation of your portfolio. And for many years, I had Brookfield. Now Google has run up so much. Google has become the largest position in my portfolio. So I will trim it and keep Brookfield as my core holding. You have other YouTubers that are doing great things, including Daniel Plonk. Brookfield is more than 20% of his portfolio. And I think it's great. It's very solid advice, solid portfolio. By the way, you can subscribe to his YouTube channel. He has a wonderful website called Stock Unlock that I'm using on a daily basis. And I'm also writing newsletters for them, for the Stock Unlock newsletter. So some people argue Brookfield deserves to be the top 1 position in your portfolio because it's safe. And I agree. If you look at the track record for Brookfield, very few people have the ability that the CEO has to just reward shareholders and operate in a very high level. Very few companies can do what Brookfield is doing. It's not always rosy, right? You have bull arguments and bearish arguments. It's okay. No company is perfect, but Brookfield is very good. So for your portfolio right now, you are watching this video, check what is important, what is not important, the 5 things that are good, the 5 things that are bad. And also you can rank in terms of priorities, risk, reward, opportunities, your holdings. The smallest holdings should be your more speculative plays. If your first company, your biggest company in your portfolio is a speculative play, you have a problem. You have a problem. And it will hurt a lot of people. It's a mistake to have a speculative play as a first position, actually. Also, for your portfolio for 2026, you want to, 1, avoid overlaps between different industries, where you don't want to be too much tech or too much energy, because if one sector gets killed, it will end badly. And 2, and it's maybe more important, you want to avoid industries that you don't understand. You want to stay inside your circle of competence. You want to be able to pitch every stock in your portfolio to a child in 1 minute. If you cannot pitch your idea to a child in 1 minute, it means you don't know enough. You have different levels of sophistication, like smart, genius, and then at the end you have simplicity. Once you go into the complex systems, the complex frameworks, you know too much information. If you have the ability to put things with very simple words and everybody can understand what you're saying, it means you know enough. This is my basic test. Also the reason why I'm making YouTube videos, to just go to this level of sophistication. Simple is great. Simple is the best, actually. if you look at all my models, DCF models, simplicity, simplicity, simplicity. This is a business practice I just love. As a way of life, I think everything is simple around me. You look at my website, you look at the link in my description, no email whatsoever. You just click, you have a video, you have testimonials, and you can click on another point to book a call with me. 2 steps, only 2 steps to get in contact with me. And we have a call. The call is simple. If we like to work together, we work together. If that's not a good match, I can give you some free advice, and then you continue on your own. That's it. Simplicity, simplicity, simplicity. Please do the best for your portfolio. You do the best for your portfolio. Simplicity. Avoid the complex industries. Avoid the industries that you don't understand. Avoid the expensive stocks. Avoid the companies that are too hard for you. You are not the smartest human on earth. That's okay. You can just beat the market with simple stocks, simple investments. I made a fortune with TPL. TPL is a very simple company. TPL, Texas Pacific Land. They own lands in Texas. That's the end of the business model. Very simple. They own lands in Texas, and people like to drill oil on their lands. And every time they drill oil, people pay a royalty to TPL. This is it. This is the end of the business model. They've been doing this for hundreds of years. I mean, the company was founded in 1888. It was a railroad company in the past. It was private and then public, and then private and then public. And then they found oil. Okay, let's go do some drilling. Okay, every time you have to drill, you have to pay a royalty to TPL. End of the business model. Extremely simple. Now they're moving on with some water and energy plays, but the core operations are still oil. These are the core operations. So very simple. You want simplicity in your portfolio. It will be easier. And by the way, if you have a simple portfolio, you will minimize the amount of mistakes you make, which is great in investing. You don't want to make a lot of mistakes. Okay. Sectors you don't understand. Sectors that are too hard. Sectors that are sexy at the moment. Rocket science. All the semiconductor niche industries. If you're not comfortable investing in these industries, if you're not sure, you can just avoid them. The way to beat the market in 2026 is to avoid complexity, because AI will accelerate, most likely. And if AI accelerates, all the AI-driven sectors like pharma, the whole medicine in general, healthcare, or tech, semiconductors, all the network effects, all the copyrights linked companies, all the data-driven companies like MSCI or FactSet, all the LLM companies, everything will be affected. Okay? So things will accelerate. And the way to still be the captain of your ship is to have simple ideas. Because if you start to go into the complexity route, you will go down this slippery slope of being more complex and more complex and more complex, and you will lose some grip. You will not really understand what is happening. You will not be able to follow up with the story because it's going too fast. Okay, if you look at my portfolio, I can pitch in 10 seconds why there are all good investment opportunities. Very simple. You don't need to be a genius. You need to minimize the amount of mistakes and then sit on your hands for 2026. So this is the best portfolio structure for long-term investors in 2026. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.